Pending home sales breaking a 6-month losing streak in May, rising almost a percentage point last month versus April. The Northeast seeing the biggest gain, up more than 15%, but the overall figure still down 14% compared to the same time last year. Our next guest warns a housing correction is dead ahead. Mark Zandi is the chief economist at Moody's Analytics. Mark, great to have you with us.
Thank you, Melissa.
It's an important distinction. You're calling for a correction and not a crash. What prevents us from seeing a crash? Is it just that the underwriting this time around is a lot better, a lot different?
Yeah, that's certainly part of it. I think the underwriting's been very good. Credit score is very high, and that makes it much less likely we'll see defaults or as many defaults, and you need those distressed sales to get a crash. And also the market itself is very tight. I mean, the vacancy rate across the housing stock is at a record low or close to, and that's in strong contrast to prior to the bust back a little over a decade ago when we were just rolling and too many homes. So lots of big differences between now and then. So not a crash, but a correction.
If we see the 10-year yield sort of, top out, at least in the short term, at 3.25% market, I'm not asking you to, play forecaster, but does that impact your call for some sort of a correction?
Well, Melissa, I do that for a living. You can do that all day long. You can ask me for all kinds of forecasts. Well, I mean, we're on a 30-year fixed rate loan. We're sitting around 6%. That's a high and obviously a real problem for first-time home buyers and trade-up buyers because their monthly mortgage payment today, if they buy a typical home, is much higher, is several $100s more a month higher than it was a year ago, and so that loss of affordability is behind the correction I see. If we stay around 6, I think the market will ultimately adjust and we get that correction. If it goes much higher than that, then we'll get a much more significant pullback in the housing market, weaker home sales, weaker house prices, and home building. 6% we can digest. It's not going to be comfortable, but we can digest it. That's consistent with a correction.
Mark, I think it was Wednesday, the 14th of June, Jerome Powell, on his way out of that presser, basically, and I'm paraphrasing a little bit, warned millennials, now might not be the best time to be buying a home. I mean, it seems to me that the Fed is doing everything they can to throw some serious cold water on what's been a pretty extraordinary housing market. If they tell you that, you got to listen to them, no?
Yeah, I missed that. That's pretty interesting. But yeah, I mean, of course, the Fed is working really hard to slow the economy's growth rate so we don't blow past full employment and exacerbate inflationary pressures. And that's through higher rates. And that means the most rate sensitive sector of the economy, that's housing, is going to feel the first of that, the first effects of that. And we are already seeing that, and we'll feel the brunt of it. So this is to script, at least so far, exactly what the Fed would want to see.
It's Karen. Thanks for coming on, Mark. I have a question about, we've seen big corporate interest in housing, the Blackstones of the world buying houses and making them available for rent. Do you think they are done with that now that rates have moved up and maybe the market's sort of topped out on prices? Or do you think they're still there because the value proposition of high rents is here for a while?
I think they're here to stay. I think this is a business model, that works a longer run. And there's a lot of capital sitting out there. These institutional investors have raised a lot of funds that they're going to deploy. Now, I suspect they're going to pause here. I don't think they're going to sell. I mean, because they're long-term investors. They may not buy in this environment. They may wait to see how things shake out, and probably makes some sense, right? Because I do expect house prices in many of these markets where they're most active in the South and the West to experience some price decline. So I think it would make sense for them to pause, but I think these are long-term projects. And by the way, going back to Melissa's first question, it's another reason why there won't be a crash, because you've got these investors in there that are, long-term investors. They're not flippers. They're not looking for a quick buck. This is a business model.
Mark, thank you so much for joining us. Appreciate it.
Sure, anytime.
Mark Zandi of Moody's. Last week, Karen, you bring up the point about these big investors being into single-family homes. Starwood announced that it was looking to sell 2 portfolios of single-family homes, which got me to thinking about this problem, if it does become a problem, of these investors selling those homes and what that does to the market.
Yeah, right. I mean, they've been the ballast. Maybe didn't need a ballast during the pandemic, right? There were tons of buyers everywhere and people were employed and you could work from anywhere, all of that. I am concerned that big corporate presence declines, and that will tilt the supply-demand dynamic and therefore prices more.